everyone. It is Monday, July 17th. Going to offer up a few slides today, a little second half of 2023 update, a little bit on the economy, a little bit on markets, kind of insights into what we're thinking. We maintain our, slightly cautious underweight positioning. We'll work through what we're seeing and why we're positioned that way, and hopefully a little bit of what we're seeing and how we're going to manage portfolios here for the second half of the year. So let's jump right into it. This first slide is going to come from us from High Mount Research. So he has these 6 fundamental things he looks at: breadth, which is how many stocks are participating in a rally; trend and momentum; sentiment; financial liquidity; economic fundamentals; and valuations. And right now you can see he puts 4 of those things in that risk category as things as saying that he does not like where they're positioned, and 2 in the positive category. And the only 2 in the positive is breadth and momentum, right? And the trend basically means the market's going up, which is great, but everything else is kind of leaning on the risk or caution side. This is a look at the S&P 500. We'll spend a little bit of time here. So as you can see, from the low in October, we've made a pretty good rally here. The thing that I'm looking at is, first, we're entering a spot in the market that has historically been resistance. You can see twice before, late 2021, the market rallied to this point and moved backwards. And again, twice in early part of 2022. Now here we are again. Is there enough momentum? Is there enough breadth to push us higher from here? The thing about this specific chart that I'm looking at in the bottom right, this is relative strength, or a good commonly used momentum indicator. 0 to 100, when we hit 70 or go beyond 70, we consider that to be overbought or really strong momentum. What that means is when it gets overbought, it means in the short term, probably expect a little pullback, but in the longer term, there was enough momentum, enough buying to push it over 70. So after that pullback, you'd expect the rally to continue. You can see we've been going here for, going on pretty close to a month, to where we've been climbing higher, but there's not been a lot of momentum. So that's something we're watching pretty closely. If this market was to roll over without that momentum hitting that 70 indicator, it could be a telling sign of a pretty decent pullback ahead. The next one is interest rates. This is the 2-year Treasury yield. You can see here in 2021, early part of 2022, when the conversation around interest rates being raised started to be had, the 2-year takes off, reaching a peak here early 2023 of around 5%. Now, this sell-off that we saw in rates down to, got as low as 3.6 there, primarily due to some of the banking turmoil that we saw early part of the year into March. Now, what's happened is we've rallied all the way back up to this 5% number in the 2-year, and the market's pretty much shrugged it off. Interest rates going higher has been the key reason for markets selling off, the dollar, helping that as well, but predominantly interest rates. Now here we are back to those same levels, and the market seems to be, hey, no big deal. The expectation is possibly starting to cut interest rates. Now, about 60 days ago, the expectation where interest rates was going to be cut in Q4 of this year. Now the market has pushed that all the way off until March of next year. So a whole different take, almost 6 months to when that's going to happen. So basically higher for longer. If you've heard that in the news, interest rates are going to remain higher from the Federal Reserve for a longer period of time. That's what was scaring the market to bits, pretty much all of 2022. Now it's happening in 2023. And again, it's kind of being shrugged off a little bit. So that is something to monitor, whether this continues to come down or stays elevated up here in the 4.75 to 5% range. Because of that, now look at the mortgage rates, right? The mortgage rates have came back. An average, you can barely see the number up there, I apologize, back to, the highs in 2022. But that number, 6.9%, is the average 30-year mortgage rate being sold in our country today. So again, massive headwind to anyone purchasing homes today. There's just not going to be a lot of free cash flow because of how much money you're spending to maintain your mortgage principal and interest balance. This is leading economic indicators. So it's looking at things like unemployment rate, GDP, stock market pricing, risk reward of the market. There's about 10 different things that go into this one number. Now you can see throughout history, any spike in major turn of these leading economic indicators has always preceded a recession. The recessions are in those dark gray lines. So in every instance where you got a large rollover, okay, there was a couple of small movements down that did not result in recessions, but any big move like what we've seen here in 2023 has always came before a recession. So I don't want to sit here and be the guy who's calling for a recession. But what I'm saying is there's enough information going on that we need to just have our eyes open and a good enough reason to be taking a little less risk. Not only has the market rallied a lot, but we're starting to see some numbers underneath the surface support an economic slowdown for sure. This is from Thrasher Analytics, a research partner of ours. This is his Maestro model is what he calls it. Again, he does not release a lot of the information on how this is built, what makes up the model, because that's proprietary in the work that he's done. The part that I want to show is these, you can't see the key. Let's see, I'm in the way. In the bottom left-hand side here, you can see the pink lines are aggressive bearish signals. Now you can see that we've got them in the past over here on the left-hand side of the red box. We've got him in the past, and it has came with a little dip here and there. He got a whole bunch here in late 2021, right before the 2022 sell-off. Well, if you look here again, these last month and a half, he's getting a big group of sell-off bearish signals again. The markets, continue to climb higher, but again, the weight of the evidence is there's enough signs coming in here that could warrant some sort of pullback. This is another one from Thrasher. Andrew Thrasher is his name. This is risk appetite. So there's about 16 inputs he uses to make up this average risk score. 50 is 0.5 is no more risk than reward, right? We're not being too aggressive or too bearish. Now, if you can see here in 2022, you can see that line bottomed at 0.2 and that green line steadily moved a little bit higher and a little bit higher while the market was actually moving lower. Okay, this is divergence, two things not equaling each other. So the market was saying, yeah, we're willing to take more risk. We're willing to take more risk, but the market continued to go down. Well, now look what's happening. The market is saying, I'm taking less risk. I'm taking less risk with that red line over here on the far right-hand side, but the markets continue to climb higher. This is divergence in the opposite direction, right? Risk taking going down, but the market's climbing higher. Yet another reason to keep our eye on the shorter term, more bearish move in the market. This is Andrew Thrasher got his name for being a volatility expert. This is his volatility risk trigger. Now, every time he gets this spike up into the 72 range, it builds a risk trigger from these green arrows. We're just getting one here. We got a whole bunch of them in about late May, early June. It just didn't result into anything, right? The big spike in volatility never came. Volatility kept going down. Well, here we are again, getting another volatility risk trigger. Another research partner will share some of his slides, Archaic Capital. He's calling for volatility to spike here in the coming weeks as well. So it's something to monitor. Volatility is just how much the market's swinging up and down on a daily basis. That can be positive or negative, but spikes in volatility are typically associated with pullbacks in the market. So another example here of why we're a little bit leaning on the cautious side. Another one is seasonality. So this is taking, this is using the INDX or the NASDAQ, all of the historical returns and all the years past, what their average is per day. And you can see that the NASDAQ typically rallies, late June into mid to, let's see, that's July 16th, mid to late July, and typically, is kind of weaker heading all the way into late August before starting to rally again. So seasonality would suggest that this is a time where maybe the NASDAQ, think growth, techie names, might take a little step back as they've been the leader so far this year. It might be time for them to give up that leadership position. Here's another one. I always follow what, the flow is of equity ETFs, and because more often than not, big moves into buying or selling, you want to take the opposite side of that. So this is 3-month flow of major equity ETFs. This is retail investors buying. And you can see when we get these huge spikes over this red line, one happened over here, market was pretty much flat and even went down, for almost an entire year. We got another spike here in late 2017, right? This is retail investors, the mom and pops, if you will, doing their own buying and selling, not working through institutions or advisors. And you can see when they got that huge spike in 17, pretty much a flat year with a pretty healthy pullback in late 2018. And again, we got all bunch of spikes here in late 2021. Everyone was going in and the market's rolling off. Now you can see here, we got another spike up to that red line over here on the far right in the red box. Okay. Doesn't mean the market has to roll over, right? But if history were to repeat itself, when retail investors are going all in, that's typically the time, we want to take a step back. This next one kind of supports that same theory. This is percentage of stocks that are over their 50-day moving average, okay? The moving average of the price per close over the last 50 days. You can see the spike back in August of 2022 created a top in the market where the market pulled off. Same thing here in late November of 2022, spike in the market sold off. So here we are hitting close to that same number that we hit the previous 2 times. But more importantly, it's kind of hard to see, but we got a little bend over. The market might be running out of steam here. We could expect the percentage of stocks over the 50-day moving average to pull back, which would result in the market pulling back a little bit as well. The next thing, this one's crazy. This is daily sentiment of the NASDAQ. Okay. So again, think tech, growth, the big names in that space, Apple, Amazon, Microsoft, NVIDIA, Tesla, right? This is the daily sentiment is just basically bullish or bearish, right? You're aggressively bullish or cautiously bearish. It is the highest daily sentiment we've seen in 23 years. Okay, so the most bulls getting the most aggressive in 23 years. Well, that would be the dot-com crash. Now, by no means am I calling for a dot-com-like crash in tech stocks. What I'm saying is this is another example of a reason why you might be a little bit cautious right now, because everyone's trying to go all in here, specifically in this NASDAQ high growth technology space. Okay, so anytime you get big spikes like this, again, at some point, we know trees don't grow to the sky. We're going to probably roll over at some point in time. This next one, again, these last couple have been from Archaic Capital, a research partner of ours. He uses this master options flow model, okay, which is basically how much options purchasing of call options, betting the market's going to go up, or put options, betting that the market's going to go down. And this red line is the action, and then that gray line you can see is kind of a moving average. And anytime those 2 numbers cross, it'll trigger a reversal. And you can see here back in February of 2022, had a little spike here and a pretty good sell-off in the market. Okay, same here in the late November this was February of 23, and then November of 2022, again, turning over with a pullback. Mid 2022. Over here in 2021, again, it got really high over here on the left-hand side. We had our trigger and the market sells off. So we just got another sell trigger here early July, yet another reason to be cautious. High-low oscillator, another momentum indicator. Again, there's some pretty good divergence here. You can see the peaks in these red moving averages have resulted in times where the market has rolled over a little bit. Now, here we are. We're hitting this peak again. There's still a little work that needs to be done. We need to actually roll over for this to trigger a sell indicator, but you can see the divergence has started. See this red line he's drawing going down? That's divergence from the market that's trending up, right? So one of these two things has to give at some point in time. Does the high-low oscillator roll over and therefore the market follows? Or is the market going to push higher and this thing's going to trend higher? So we haven't quite got the sell signal yet on that, but definitely another one that we're watching. So that's my last one. Hopefully those charts give a little indication of what we're thinking. Clearly, most of the research we're seeing right now is to be a little cautious. Again, the market's been on a really good rally. We've participated. We took a little off the table here a little bit early, which is hindsight. It sucks when you make that decision and, the market moves against you. But again, we're thinking 6, 18, 6, 12, 18 months down the road, not necessarily these last, 4 to 5 weeks that the market's kind of moved against us. So the evidence is there for us to stay a little bit cautious. Now we're just going to monitor really closely to say, hey, are we going to get this pullback or is the market going to keep rallying and we need to get back in? Right now, the numbers and the research would suggest to us that pullback opportunity is going to come, and we have to just maintain our patience and our structure and believe in our process here. So as always, if you have any follow-up questions, don't hesitate to reach out, give me a call, shoot me an email. Happy to help any way we can, and we'll try to get out another update just as soon as we can. So hope you all have a great week, and we will talk to you all very soon.